Welcome to the webcast presentation of our results for the half year ended 31 December 2025. I am Nico Miller, the CEO of Implats. This presentation provides a high-level overview of our group's performance over the first half of the financial year. Before we begin, I draw your attention to our normal disclosure statement pertaining to any forward-looking statements that may be made today. I will start today's presentation with an overview of the group's performance and the key features. This will lead into an account of the group's operational performance presented by Patrick Marutwa, our Chief Operating Officer, followed by the financial results presented by Meroonisha Kerber, our Chief Financial Officer, and then Sifiso Sibiya, our Group Executive for Refining and Marketing, will provide an overview of the PGM markets before I finish off with our key focus areas and the outlook for the remainder of financial year 2026. We continue to strengthen our commitment to a safety-first culture at all our operations, and we remain deeply committed to the well-being of our employees. The group's strategic safety program continued to advance during this period, with a steady progress recorded across all operations. Compliance with critical safety behaviors continues to vary, underscoring the need to further embed consistent, safe operating practices. We are pleased to report that no fatal incidents were reported at group mining and processing operations in the 6-month period. Regrettably, however, an employee at Impala Rustenburg was fatally injured in a motor vehicle accident in December 2025. It is also with profound sadness we report that post-period end, one employee was fatally injured in a rigging accident at Impala Rustenburg's South Shaft. We acknowledge the safety delivered across our managed and joint venture portfolio, which led to a 7% improved lost time injury frequency rate. The total injury frequency rate deteriorated marginally, largely due to the precautionary medical referral of all employees exposed to smoke inhalation following an underground fire in the first quarter. Implats seeks to demonstrate best practice in environmental management, guided by our environmental strategy and ESG framework. I am pleased to report that we achieved further progress in our sustainability journey during the period. We delivered a sound environmental performance with no major, significant, or limited environmental incidents. Our renewable electricity use in the period was steady at 31%, and our water recycling and reuse remained high at 57%. Zimplats' first 35 MW of its intended 185 MW solar power complex reached design capacity during the period, and construction has started on the 45 MW second phase, which is on track for technical completion in August 2026. All tailings storage facilities retain compliance in the annual Independent Tailings Review Board audit. Our achievements were again recognized by several global agencies in their annual rankings and ratings. The group continued strengthening sustainable community development in the first half. Our social and labor plans and beyond compliance projects focused on community well-being, education and skills development, enterprise and supplier development and inclusive procurement, as well as developing resilient community infrastructure. Across the group, these initiatives benefited over 43,000 people and supported more than 2,900 community jobs in the period. Implats delivered a robust operational performance across its mining and processing assets. Notable gains were achieved in the second quarter, underpinned by delivery at our key operations and greater stability in the processing portfolio. Group 6E production increased by 1% to 1.8 million ounces. Refined 6E production, including the saleable ounces from Impala Rustenburg's North Shafts, which was formerly known as Impala Bafokeng, and Impala Canada, was stable at 1.78 million 6E ounces. We report an 11% unit cost increase for the period. Mining inflation was compounded by spend on engineering and infrastructure initiatives and structural salary adjustments at Zimplats. Group capital expenditure declined as several processing and expansion projects were completed, with the timing of cash flows and projects also impacting reported spend. Our operational delivery enabled Implats to fully benefit from the step change in Rand PGM pricing, resulting in a strong financial performance and free cash flow generation. The group generated an EBITDA of 18.1 billion rand, headline earnings of 9.3 billion rand or 1,035 cents per share, and recorded a free cash flow of 7 billion rand. Implats closed the period with an adjusted net cash balance of 12.1 billion rand and 28.8 billion rand in liquidity headroom. The Board of Directors declared an interim dividend of 410 cents per share, representing a payout of around 60% of adjusted free cash flow generated in the 6 months. I will now hand over to Patrick Marutwa, our Chief Operating Officer, who will take you through an overview of our operational performance.
Thank you, Nico. The groups delivered a commendable production and cost performance. Turning to the specific contributions to group PGM production from the different operations. Production at our managed operations increased by 1%. It is important to note that the consolidation of the Impala Rustenburg complex was completed in FY 2025. As a result, reported production volumes from Impala Rustenburg now comprise stock-adjusted ounces from the South and Central Shaft, together with ounces of saleable metal from the North Shaft, formerly known as Impala Bafokeng. On this consolidated basis, 6E production declined by 2%. In the first quarter, momentum was negatively affected by increased regulatory stoppages and unstable power supply. Zimplats benefited from strategic interventions to ease mining constraints, with improved availability of trackless mobile machinery, supplemented by open pit ore throughput. Production in the prior period was impacted by the accumulation of inventory on smelter commissioning. At Impala Canada, as previously communicated, the production profile is tapering on the shortened life of mine and the operation delivered to plan. Although Marula reported lower production, the operation delivered to plan as we focus on increased development to address constrained mining flexibility and benefited from increased employee efficiencies. Production from our joint ventures declined by 3%. At Two Rivers, grade and yield improvements offset reduced mill throughput, while Mimosa's volume declined due to processing instability and increasingly challenging ground conditions as mining progresses into the outer extremities of the ore body. Finally, third-party receipt benefited from improved deliveries from the underlying customer operations. Refined 6E production, which includes saleable ounces from Impala Rustenburg North Shaft and Impala Canada, was stable. Processing operations performed well, with record milling rates delivered at Base Metal Refinery. The scheduled rebuild of Furnace 4 was initiated as planned in December 2025. Implats ended the period with excess inventory of approximately 400,000 6E ounces, 20,000 ounces lower than at our FY 2025 year-end. Inventory increased as expected in the first quarter as annual maintenance was completed, with a drawdown of 80,000 ounces in the second quarter. Capital expenditure declined as processing projects at Zimplats were completed and commissioned. Capital expenditure at Impala Canada was expensed in a period. The sustained improvement in PGM prices enabled us to start revalidating feasibility studies and early works for a phased restart life of mine reserve extension project. This includes Impala Rustenburg's 14, 20 and BRPM North Shaft and the Two Rivers Merensky project. In terms of our ongoing project, the Mopani mine replacement at Zimplats remains a cornerstone of long-term volume strategy and remains on target for technical completion in August 2028. The Zimplats 45 MW second phase solar plant is advancing well. Impala Refinery's new Finals Metals Phase 4 project is progressing as planned. Reflecting our disciplined approach to cash management, the Zimplats SO2 abatement project were rephased, with Phase 1 set to resume in the third quarter. Meroonisha Kerber, our Chief Financial Officer, will now outline the group's financial performance for the period.
Thank you, Patrick. Implats delivered a strong financial performance with significantly improved EBITDA, free cash flow generation, balance sheet strength, and liquidity headroom. The benefit of strong metal pricing was maximized through a commendable operating performance and sustained cost control. This strategic delivery supported improved shareholder returns, with circa 60% of adjusted free cash flow generated returned to shareholders through the interim dividend. Looking at some of the detail, financial metrics were boosted by the combination of stable 6E sales volumes delivered into higher metal pricing in the period, particularly the prices received for platinum, rhodium, palladium, and ruthenium. Rand appreciation only marginally offset the benefit of stronger US dollar metal prices. Moving to the cost performance in the period, group mining inflation of 5.5% was compounded by additional engineering and infrastructure spend as we continue to improve asset integrity and performance across our operations. In total, group cash costs increased by 10%. Depreciation rose 30% on higher charges at Impala Rustenburg's North Shafts and accelerated depreciation at Impala Canada. The movement in stock reflects higher metal pricing and unit costs. Profitability at both joint ventures, Mimosa and Two Rivers, rebounded on higher achieved sales revenue and sound operational delivery. Reported earnings from associates were, however, impacted by unrealized profit in stock adjustments of almost 1 billion rand. Implats recorded EBITDA of 18.1 billion rand at an EBITDA margin of 30%. Headline earnings and headline earnings per share rose more than fivefold to 9.3 billion rand and 10.35 rand per share. Group stock adjusted unit costs increased by 11%. Group mining inflation of 5.5% contributed 1,120 rand per ounce to the unit cost increase. Changes in volumes and yield resulted in a 727 or 3.5% increase. Higher spend on engineering and infrastructure resulted in a 515 rand or 2.5% per ounce increase, while the translation impact of the stronger rand on the cost base at Zimplats and Impala Canada resulted in a 134 rand per ounce benefit to unit costs. Maintaining an optimal capital structure and a strong and flexible balance sheet through the cycle remains a key strategic priority, and I'm particularly pleased with the developments we are reporting today. Cash generation rebounded on the step change in PGM pricing, with net cash from operating activities increasing to 9.8 billion rand from 3.6 billion rand in the prior comparable period. Free cash flow benefited from moderated capital expenditure outflows as processing projects at Zimplats neared completion and the Phase 2 project spend at Marula was halted. In total, Implats recorded a free cash inflow of 7 billion rand. Cash and cash equivalents increased by 3.9 billion rand, and after accounting for exchange rates, the group closed the period with cash and cash equivalents of 15.2 billion rand. During the period, Implats refinanced its committed revolving credit facility, which now consists of a 12 billion rand ZAR tranche and $120 million tranche, with associated accordion options of 2 billion rand and $30 million respectively. These facilities are in place until September 2028, with an option to extend for a further 2 years. As part of the refinancing, certain changes were made to the definition of net cash or debt in calculation of the covenants. This has resulted in the group's restated definition of this metric, which closed the period at 12.1 billion rand adjusted net cash. Together with undrawn facilities of 14 billion rand available on the revolving credit facility, Implats closed the period with improved liquidity headroom of 28.8 billion rand. Our capital allocation framework aims to deliver, sustain, and grow meaningful value for all our stakeholders. As a reminder, we first allocate cash flow to sustaining capital, which ensures that our assets operate safely, optimally, and sustainably. Thereafter, we adjust free cash flow in each period for non-discretionary outflows and add back expansion capital. We then allocate the resultant free cash flow across three broad pillars of balance sheet strength, growth and investment, and shareholder returns. After adjusting for foreign exchange translation losses, the group realized an adjusted cash inflow of 6.2 billion rand. 2.2 billion rand, or 36%, was allocated to strengthening the balance sheet. Of this, 1.4 billion rand was paid in additional taxes shortly after period end. Circa 200 million, or 3%, was directed towards growth and investment, primarily to fund strategic projects at the group's processing operations, together with contributions to AP Ventures. Implats' dividend policy is premised on returning a minimum of 30% of adjusted free cash flow after growth capital. However, after considering the group's financial performance, robust balance sheet, and the prevailing market conditions, the board declared an interim cash dividend of 410 cents per share, amounting to 3.7 billion rand. Including dividends paid to minorities in the period, this equates to approximately 60% of adjusted free cash flow returned to shareholders. Adjusting for the additional tax payments, this rises to an allocation of 80%, aligned with our philosophy to provide returns above the dividend policy minimum during supportive market conditions. Sifiso Sibiya, our Group Executive for Refining and Marketing, will now discuss the PGM market.
Thank you, Meronisha. Trade, policy, and geopolitical uncertainty intensified through 2025, perpetuating macroeconomic volatility. This supported increased investor market interest in precious metals, amplifying flows into physically constrained PGM markets. Lease rates remain elevated by historical standards, signaling ongoing tightness. Liquidity was further constrained by ETF purchasing and rising U.S. inventory levels. U.S. trade policy remained a key risk, with Section 232 investigations into critical minerals and potential anti-dumping duties on palladium of Russian origin elevated concerns about potential tariffs on PGMs. The platinum and palladium futures launch on the Guangzhou Futures Exchange further reshaped PGM market dynamics, with exceptional early trading volumes ahead of increased margin requirements in late December. After a lengthy period of range-bound trading, the platinum price ignited in late May 2025. Strong prices persisted into the closing months of 2025, with elevated futures volume and ETF purchases driving prices through $2,000 per ounce. Platinum is deriving support from historically high gold prices, with the price rally supported by underlying market fundamentals. Palladium pricing was boosted by its association with platinum and, to a lesser degree, gold, as well as notable physical tightening over 2025 as U.S. anti-dumping investigations made headline news. Meanwhile, rhodium pricing gained steadily over 2025, with rising concerns about tariffs and highly consolidated geographic supply lending price support. While the minor PGMs are not screen traded, market consensus is that speculative investment and stockpiling have boosted prices and tightened markets for rhodium, ruthenium, and iridium. Our received dollar basket price improved by 44% to $1,917 per 6E ounce sold. Rand appreciation marginally offset the benefit of stronger US dollar metal prices, and rand revenue increased by 40% to 33,261 rands per 6E ounce sold. Constrained primary supply, robust industrial demand, and resilient jewelry and investment offtake resulted in all three major PGM markets of platinum, palladium, and rhodium recording market deficits in 2025. Both platinum and palladium are expected to remain in deficit in 2026. The rhodium market is expected to be broadly balanced in 2026 as secondary supply increases and South African producers reduce previously accumulated in-process inventory. Demand is vulnerable to lackluster auto forecasts for sales and production, with upside demand risk from higher catalyzed vehicle market share and another period of strong physical investment demand. PGM pricing is likely to be driven by broader macroeconomic and geopolitical factors. The prevailing backdrop of security of critical mineral supply is likely to lend pricing support. Turning to supplies, primary supply is for each of platinum, palladium, and rhodium in 2025 as North American production profiles were adjusted in response to low prices and the release of inventory at South African producers eased from the elevated levels seen in 2024. South African production expectations were also downgraded during the year as extreme weather events and processing maintenance undercut outturn. Primary platinum and rhodium supply should increase marginally in 2026 on improved capacity utilization at South African processing assets. Palladium volumes, however, will reflect the short-term dip in focus supply from Russia and are expected to retrace. Secondary supply delivered largely to expectations in 2025, with limited upward adjustments to collection rates during the year, despite the rapid improvement in pricing and the implied economics of scrap. The cost and complexity of collecting, funding, and transporting spent material remains high. However, shifts in trade policy and increasing concerns about the security of critical mineral supply should shift the existing channels for aggregation to centralized processing facilities in developed world territories. Our base case estimates assumes that collection rates will improve in line with the recovery in light vehicle sales, and that the collective platinum, palladium, and rhodium supply from secondary sources will increase by 9% in 2026. Nico will now conclude this presentation.
Thank you, Sifiso. Encouraging operational momentum and stability across the processing assets provides a solid foundation for delivery for the remainder of our financial year. Key operational priorities include maintaining the improved safety performance, further embedding the enhanced maintenance protocols across the processing operations, consolidating efficiencies and strengthening productivity across the expanded Impala Rustenburg complex, and realizing the benefits of improved mining flexibility and operational stability at Marula. Our strategy remains anchored in safe, efficient, and profitable production, optimal capital allocation, and unlocking the considerable value inherent in our portfolio. Strong free cash flow generation, combined with a robust balance sheet and our strategic focus on the delivery of long-term value creation underpins our capacity to navigate challenges and maximize opportunities. Implats' guidance on production, unit cost, and capital expenditure remains unchanged from the previously provided guidance with the release of our 2025 financial year-end results in September last year. Group 6E refined and saleable production is expected to be between 3.4 and 3.6 million ounces. Group unit costs are expected to be between 23,500 and 24,500 rand per 6E ounce on a stock-adjusted basis. Group capital expenditure is forecast to be between 8 and 9 billion rand. This guidance assumes an exchange rate of 16.85 rand to the US dollar and 1.38 Canadian dollar to the US dollar. Thank you for taking the time to listen to this webcast.